Today is May 12th, 2026, and the world just woke up to a reality that the paper market spent 8 weeks trying to ignore. My name is John, and I told you this was coming. We are sitting at $86 and rising, but the price is actually the least interesting part of the story. The real story is the 5 words Donald Trump posted to Truth Social that effectively ended the era of negotiation. He said, and I quote, "totally unacceptable," end quote. Those 5 words just killed the ceasefire trade and allowed the physical reality of the vault to take over. If you are someone who has spent your whole life saving only to watch the system devalue your effort in real time, make sure to hit the subscribe button and give this video a thumbs up, because what I am about to show you is the end of the paper illusion. Most people are looking at this move and asking when the price will dip back to $80. They are asking the wrong question. They are suffering from normalcy bias, assuming that because things were quiet yesterday, they must return to quiet tomorrow. But the spike is not the setup. The spike is the market finally admitting that the physical thesis was right all along. The next 72 hours are going to be more important for your portfolio than the last 5 months combined, because we aren't just watching a price move. We are watching the structural collapse of a diplomatic framework. Let's look at what actually landed on the president's desk, because the mainstream headlines are only giving you the reaction, not the underlying cause. Iran did not just send a counterproposal, they sent a suicide note for the American diplomatic strategy. Their formal response contained 4 specific demands that were never meant to be accepted. They asked for full control over the Strait of Hormuz, the lifting of every single economic sanction, the return of $120 billion in frozen sovereign assets, and, most audaciously, war reparations for the military damage caused during the conflict. This is what geopolitical strategists call a poison pill. In the world of high-stakes game theory, you do not send a list like that if you genuinely want a deal. You send it when you want to prove to the world that negotiation is mathematically and politically impossible. It is a form of sovereign humiliation designed to force the other side to either blink or strike. By demanding $120 billion and the literal keys to the most critical maritime choke point on the planet, Iran essentially told the White House that the previous 14-point memorandum was not worth the paper it was printed on. We are watching a classic hawk-dove dynamic play out, but for the first time in this entire conflict, the market is completely pricing in the hawk scenario. Both sides have publicly burned the bridge. While the politicians were busy posturing on social media, the physical vault was busy asserting reality. For 8 agonizing weeks, the paper market tried to suppress the price, keeping silver artificially pinned below $80. They did this under the blind assumption that a ceasefire would eventually kill the war premium. They were betting on a peace that was never coming. This is a textbook, real-time case of Gresham's Law, an economic principle which states that bad money drives out good money. In this scenario, the bad money is the infinite supply of paper-silver contracts, and the good money is the finite, heavy, physical bullion being quietly drained from Western vaults. Think of the current market structure like a crowded theater where someone just yelled fire. For months, everyone has been sitting comfortably in the dark, clutching their paper tickets, completely ignoring the smell of smoke. Yesterday morning, when that Truth Social post went live, the lights violently came on. Suddenly, every institution holding a paper contract realized there is only one narrow exit, and the door is getting smaller by the minute. The paper shorts were caught dead to rights on the wrong side of an $86 move because they believed their own illusions. They genuinely thought they could print enough paper derivatives to offset the fact that the world is structurally running out of physical silver. Right now, the registered pool at the Comex is sitting at or below 79.8 million ounces. To put that catastrophic number in perspective, we are looking at a cumulative supply deficit of over 762 million ounces since 2021. This is the 6th consecutive year of supply shortages. But to truly understand where we are going next, we have to pull back the lens and look at the mathematical compression that is happening beneath the surface. Veteran market analyst Michael Oliver has been tracking commodity supercycles for 5 decades, and he is officially calling this the beginning of Phase 3. If you have followed precious metals for any length of time, you know the cycle. Phase 1 is stealth accumulation. This is where smart money builds massive positions while the asset trades sideways for years, and the mainstream media completely ignores it. Phase 2 is the structural breakout. The asset breaks its long-term resistance, the trend becomes visible, and early adopters enter as prices climb in an orderly fashion. We saw this when silver finally shattered the $50 ceiling that had acted as a brick wall for 40 years. But Phase 3 is an entirely different beast. Phase 3 is parabolic repricing. This is where mathematical compression releases all at once. This is where decades of suppressed value reprices in a matter of months, and the sheer violence of the move stops making sense to people who are still using traditional financial frameworks. During Phase 3, volatility expands dramatically, valuation models shatter, and the mainstream media starts screaming about a bubble. But it is not a bubble, it is the rubber band snapping back to reality. Oliver tracks a very specific metric to validate this phase, the silver to gold ratio. Historically, during extreme Phase 3 blow-offs, this ratio compresses violently. During the 1980 Hunt Brothers squeeze, the ratio hit roughly 6.5%. During the 2011 peak, it hit 3.1%. Right now, even after the recent massive run-up, the ratio is sitting near a mere 2%. If gold continues its structural climb toward $8,000 an ounce, and the ratio merely returns to the 2011 peak of 3.1%, the mathematically implied price of silver is $250 per ounce. If it touches the 1980 extreme of 6.5%, you are looking at silver over $500 per ounce. Now, you might be thinking those numbers sound absolutely insane. And they do, until you look at what literally just happened to the Comex paper market today. Before the Asian markets even had a chance to open, something occurred that has never happened in the 150-year history of American precious metals trading. The exchange was forced to halt silver trading twice in a single session. Not once, twice. The first halt lasted 23 minutes. The second halt lasted 41 minutes. In between those emergency circuit breakers, silver exploded from $85.20 to $107.80. This was a price explosion that fundamentally broke the exchange algorithms. They did not halt trading during the 1980 squeeze, or the 2008 financial crisis, or the 2020 pandemic crash. A double halt is not a volatility event. It is the sound of a market structure completely breaking down in real time. Here is the exact anatomy of the collapse. Silver opened with heavy volume, trading 18.4 million ounces in just 15 minutes. It spiked to $96.80, triggering the first halt. When trading resumed, it gapped straight to $99.90, moving 26.8 million ounces in 20 minutes before triggering the second halt at $107.80. For the entire session, an unbelievable 284 million ounces of paper silver traded hands. That is roughly 52% of the entire global annual mine production traded in a single afternoon. But why did they really pull the plug? Because at $96.80, approximately 220 million ounces of paper short positions went catastrophically underwater. By the time it hit $107.80, another 150 million ounces faced fatal margin calls. The shorts needed to buy hundreds of millions of physical ounces to cover their leveraged bets, but the registered vault holds less than 80 million ounces. The math simply broke. The exchange halted trading not to protect the retail investor, but to prevent the mathematical impossibility of the paper system from becoming globally visible. This is where it gets really interesting, because the timing of this collapse is not a coincidence. This catastrophic double halt happened exactly 48 hours after the Shanghai-Dubai Gold Exchange announced they are launching a physical silver settlement system that entirely bypasses Western paper markets. It happened exactly 72 hours after industrial buyers in Japan reported paying an 89% premium for physical silver over the paper spot price. And it happened exactly 1 week after major silver mining companies started refusing to honor forward sales contracts at artificially suppressed prices. We are witnessing the death of Western pricing authority. The Global South, the BRICS Plus nations, and the major Asian industrial hubs consume roughly 75% of the world's physical silver. For decades, they have been forced to accept prices dictated by paper speculators in New York and London. That era is officially over. When Shanghai and Dubai offer direct physical settlement, they create a parallel financial architecture. When the exchange halted trading today, the arbitrage pressure exploded instantaneously across these eastern networks. During the first halt, the Shanghai-Dubai silver price spiked $4.30 in 23 minutes. Eastern buyers realized they could bypass the frozen American system completely. This shift is permanent. Industrial manufacturers producing solar panels, military electronics, and electric vehicles do not care about paper contracts. You cannot build a cruise missile or a high-efficiency solar array with a futures derivative. You need the physical metal. And once that physical metal is embedded into a solar panel or a semiconductor, it is functionally removed from the global supply chain forever. It does not get recycled. It is gone. If you want to understand the true leverage in this Phase 3 environment, look at the mining sector. Right now, a typical silver mining operation has an all-in sustaining cost of around $20 per ounce. At an $80 silver price, that miner is earning $60 of pure profit margin per ounce. It is a fantastic business. But if this physical squeeze pushes silver to $300 an ounce, that same miner, with the exact same $20 cost base, is suddenly earning $280 of margin per ounce. The spot price of silver multiplied by less than 4, but the miner's profit margin expanded by nearly 500%. That is the exponential mathematical leverage that institutions are currently scrambling to price in. The paper illusion is actively burning to the ground. The physical reality of supply deficits, global resource nationalism, and unbacked derivatives is colliding all at once. The market is transitioning from an age of financial abstraction into an age of hard, physical reality. The Western system just failed its ultimate stress test, while the alternative Eastern systems kept running perfectly. The double halt was simply a panicked admission that it no longer controls the true price of capital. So, where does this leave us as we move toward the end of this historic week? There are two paths from here, and your strategy depends entirely on which one activates in the next 48 hours. Scenario 1 is the total acceleration. If silver holds above $83 through the London Open tomorrow, we are looking at a clean run toward $92 and beyond. This would not just be a rally, it would be the final migration of wealth from paper promises to physical reality. But then there is scenario 2, the strategic pullback. If a back-channel deal is struck through Oman or Turkey, the paper shorts will try one last time to force the price back toward the $80 range. But here is the truth the system does not want you to hear. A temporary ceasefire does not refill the vault. It does not fix a 762 million ounce deficit. A dip in price is not a change in the story. It is simply a second chance for the prepared to exit the digital illusion and enter the physical world before the door locks for good. History does not care about your feelings or your timing. It only cares about who holds the collateral when the music stops. If this changed how you see the system, subscribe and leave a comment below. See you soon.